Okay, let's go.
Welcome to The Explainer. Today, we're going to pull back the curtain on the world of retail trading. You've seen the ads, right? You've heard the promises of making a fortune from your couch. But we're going to ignore the hype and look at the cold, hard data and the hidden system that the pros know inside and out, but that most people never, ever see. All right, let's just dive right in. The entire industry is powered by this one incredibly potent dream. The idea that you can achieve financial freedom, you can quit the 9 to 5, and just make a killing from your laptop anywhere on Earth. I mean, it's a powerful lure. And that's the bait on the hook that pulls in millions of people, hoping to completely change their lives. But that dream, well, it pretty much immediately crashes headfirst into this one single brutal number. For almost everybody who gives this a shot, this is the only number that ends up mattering.
And it even has a name, the 90-90-90 rule. Let that sink in for a second. 90% of new traders lose 90% of their money in the first 90 days. Now, the most important thing to get here is that this isn't just a string of bad luck. It's not an accident. It's the predictable, you might even say engineered, outcome of the system itself.
So, you gotta ask, right? Why? How can it be that bad? Well, the answer is a little uncomfortable, but it's actually pretty simple. The retail trading industry, from the ground up, is just not built for you to win. So let's break down how this whole game really works. All right, the first secret is all about your broker. We tend to think of them as just a neutral platform, a tool we use to trade, but their business model has this massive hidden conflict of interest, where, believe it or not, their goals are pretty much the exact opposite of yours. So how do they really make their money? Well, there are three main ways. First, you've got the obvious stuff, the spread and the commissions on every trade you make. Okay, fair enough. Second is the financing turn, which is the interest they make on any money they lend you for leverage. But the third one, that's the big one, OTC gain, over the counter. See, a lot of brokers aren't just sending your order to the market. They are the market. They're taking the other side of your bet. So when you lose money, they win. It's a direct profit for them from your loss. So let's just be crystal clear about what this means. Your broker is financially incentivized for you to trade big, to trade often, and to lose. This quote here really nails it. The whole system isn't for your benefit. And this fundamental conflict of interest, well, it's the bedrock of the entire retail trading world. Okay, but the rabbit hole goes deeper. Let's move on to the next layer of this industry. All those trading gurus and online educators who pop up on your social media feed, promising to teach you all the secrets to winning. So here's the dirty little secret behind this whole education industry. Most of these gurus have something called an introducing broker agreement, or an IB agreement. Basically, it's a contract where they get a fat kickback. We're talking 25, sometimes even 50% of all the revenue you generate for the broker that they sent you to. Now just think about what that means for a second. The guru's paycheck is now tied to your trading volume, how often you trade, and yep, even your losses. Suddenly, their financial goals are identical to the broker's, not yours. They're not teachers anymore. They're basically just a marketing department for the brokerage, cleverly disguised as your mentor. So how do you spot these guys? Well, you've got to watch out for these classic massive red flags. Do they promise day trading always works? Do they sell you this dream of a steady monthly income like it's a regular job? Do they spend more time showing off rented Lamborghinis and mansions than they do talking about risk management? And here's the kicker. Ask for their verifiable, professional, regulated track record. If they can't provide one, you're almost certainly dealing with a charlatan. And this really just sums up the whole disconnect. On one side, you've got this carefully crafted image, the supercars, the stacks of cash, the lavish lifestyle. But on the other side, behind the curtain, is the reality of how they make their money, which is from your losses, not from their trading. Okay, so we've seen the trap. Now let's flip the coin and look at the other side. How does this retail world stack up against the world of actual professionals, the people working at big investment banks and hedge funds? Look, inside the financial industry, and I know this sounds harsh, they basically see the market as two groups of people. First, you've got the smart money. These are the professionals, the institutions that know the system inside and out. And then you've got what they call the dumb money, and that's the retail traders. You guys are seen as the liquidity, the constant flow of small orders that the smart money needs to be able to execute their own much, much larger strategies. And this table just lays it out, clear as day. Professionals are focused on systematic portfolio management. Their number one rule is capital preservation. Their goal? Get rich slowly. Retail traders, on the other hand, are taught the exact opposite. Go for short-term, all-in bets, chasing those huge, quick profits. They're not just playing the game differently, they're playing two completely different games.
So here's the big takeaway from all this. Winning is actually possible, but it requires you to completely throw out the entire retail narrative you've been sold. You have to make a fundamental shift and start thinking like a professional. But let's ask the question head on. With a whole industry pretty much designed to work against you, is making consistent money even a realistic goal for a regular person? I mean, can you actually beat the house?
Well, instead of just guessing, let's look at some cold, hard data. Because of public company filings, we can actually get a rare, unfiltered peek inside one of the biggest and best trading firms in the world. Now, check this out. This chart comes straight from Goldman Sachs' own public annual report. In 2015, out of all the trading days in the year, their trading desks made money on 212 of them, and they only lost money on 38. 38! That's an 85% daily win rate. And if you look at their numbers over the last couple of decades, it's consistently hovering right around 90%. Now think about that. It's the perfect mirror image of the 90% loss rate for retail traders. They are literally on the winning side of that 90-90-90 rule. And why is that? Do they have some secret crystal ball? No, the reason is actually simple. Their entire approach to the market is the polar opposite of what the brokers and the fake gurus are teaching you. They preserve capital, they manage risk, and they focus on long-term consistency, not on short-term lottery tickets. So here's the path forward. If you want a real shot at this, you have to play a completely different game. First, you have to understand the conflicts of interest we've been talking about. Second, question every single so-called guru and demand to see their regulatory history. Third, you've got to adopt a professional's approach. That means long-term thinking and serious risk management. And finally, and this might be the most important one, you have to embrace the goal of getting rich slowly. It's about staying in the game, not hitting one lucky home run. So at the end of the day, the information is all out there. The first and most critical step to winning isn't some secret indicator. It's just understanding how the game is designed to make you lose. The real question is, now that you know, what are you going to do about it?